One day from the FOMC, and of course, we'll be diving into what the Fed is going to do around rate cuts, but also take a look at some of the macro elements that could be directing the markets, not only now, but maybe in the next few weeks. We'll break it all down for you guys. My name is Paul Barrow. Welcome back into Tech Path. Before we get started, we want to thank our sponsor, and that is Coinbase. If you guys are looking at going into your first crypto trade, you can do that over on Coinbase. Very easy. All you have to do is jump to coinbase.com. The future of money is here, and it's a great place to get started. And also, if you've never traded before, it's very easy to set up. So just use our link down below. You'll get $200 in crypto to get started and get going here. I want to bring in our guest today, and that is Mr. Jim Bianco, coming in from Bianco Research. Great to have you, Jim.
Thanks for having me.
Yes. All right. So, Jim, I want to get into a few points today. You look at some of the retail sales data that came in a little bit less aggressive, I would say, but it definitely wasn't bad news for retail in general. How much of a direction do you think those numbers are going to have in terms of data on Chair Powell's decision? I guess they've already probably made the decision, but will this have any implications on tomorrow's rate cut?
Well, normally I would say to you that no, it'd have no impact on the decision. And normally I would agree with you that yes, the decision has already been made. But this meeting is shaping up to be unlike any meeting we've seen, at least since the 1990s. There's genuinely confusion and uncertainty about what the Fed's going to do, and that includes the Fed itself. So marginal data like the retail sales the day before, maybe even the home sales numbers out tomorrow morning about an hour or so before they finish, may swing the tide. The tide is Fed's going to cut rates tomorrow. Are they going to cut rates 25 basis points or are they going to cut rates 50 basis points? Give you two statistics. The market pricing, you can actually go into the financial markets and get a probability. And the probability is about 64% that the Fed will cut by 50 basis points. But Bloomberg does a survey of over 120 Wall Street economists, and 80% of them think the Fed's going to cut 25 basis points.
Okay.
We've never seen this. I mean, I got to go back. I got data going back into the 90s, and I can't find a situation where the economists and the street and the market pricing are not on the same page a day before the meeting.
Yeah, I think that is we're just showing your tweet right here, going back to the 1990s, back to the 50-50 point you're talking about, just in the essence of just before the meeting. When you look at the data, though, and the comparison of what markets are pricing in, how much of an impact do you feel the market itself, S&P, traditional stocks and bonds, will have? Let's go and play both angles. If it comes in on a 25, how do you feel the market will react?
You know, that's a good question, and how the market's going to react. I mean, tomorrow, I think the market's going to react that bigger rate cuts are better, less rate cuts are less. And I would emphasize that would be tomorrow. I think once you look past whatever gut reaction we have in the market tomorrow, really the question comes, what does it mean if the Fed goes 25 or 50? I've heard a lot of people say to me, who cares if they go 25 or 50? I guess in that respect, it doesn't matter. It's more of a signaling is what it is. If the Fed were to cut 25 basis points, it probably signals that they're going to stop around 4%.
Okay.
If the Fed cuts 50 basis points, it probably signals that they're going to stop probably under 3%. So it's really not about what they do tomorrow. It's about, they're going to start a journey, and how far do they think they need to go on the journey? And that 25 or 50 goes a long way to telling us how far they think they're going to go on the journey. And how's the market going to react to it? Like I said, tomorrow, bigger rate cut better, smaller rate cut less. But after that, the market is going to have to grapple with a question. If they were to go 50, and they signal rates are going to go under 3%, is that too much? Is that going to be overly stimulative and cause inflation? In which case, after tomorrow's reaction, you could see a bad reaction in markets. If they don't think that that's too much, you'll see a good reaction. On the converse, if they go 25 and the market decides they're going to stop at 4, does it think that's not enough?
Right.
They need to go further. You could see a bad reaction to that after tomorrow. But if they think, no, that's good, that's all we need to do is go to 4, that you could get a good reaction. So that's really what it's about. It's not so much about what they do tomorrow. It's about what they signal they think they're going to be doing in the months ahead.
So many people, of course, have kind of compared whether or not this rate cut gets us into maybe the perceived soft landing where a 50 might come in and say, all right, things are a little bit more heated in the markets than what we anticipated, mostly coming from jobs numbers, I assume, because the retail numbers didn't necessarily, emphasize that. So when you look at that, and back to your point, whether you get a below 3 or around the 3 range or in the range of 4, long term, over the next 6 months into 2025, wouldn't the 50 be in a position to give the markets more of a run up into 2025 in terms of long-term equity?
I really think it comes down to the other part of the mandate that the Fed has, and that's inflation, and whether or not the inflation rate has really been solved. Now, let me put this debate into proper perspective. There was a Federal Reserve Governor, Dan Cohen. He was on the Fed from 2009 to 2017. 2017, he left and he went to the Brookings Institute and gave a speech. The Fed has no theory on inflation. We have no theory on inflation in general. We don't know why inflation goes up or down. We have certain ideas about how it could work. Now, the reason I bring that up is because I happen to fall into the camp, like some others. The single hardest thing to do in this economy is project where inflation is going to go. But there's a lot of people that think the single easiest thing to do is project where inflation is going to go. And they're saying, don't worry, we're in the last mile. It's going to go to 2%. Now, these are the same people that said it was transitory 3 years ago. These are the same people that sounded the alarm bell at 9% when it was at the peak. They were wrong in both of those cases. Now they're telling us it's going to go back to 2. So it really comes down to, where does inflation go from here? Does it continue on this path towards under 2% like it was pre-COVID? Which case, it gives the market a lot of comfort if we get an aggressive rate cut. If it doesn't, and if inflation stays sticky at around 3 or 4%, and yeah, if you're not familiar with the bond market and inflation, the difference between 2 and 3% is big. It's a big difference.
Yeah.
It would be bad. It would be very bad. We saw, it would be akin to what we saw in 22, when the markets were worried that the inflation was not under control. Stocks fell 25% and bond yields rose by hundreds of basis points. I don't think they do something that drastic this time around, because back then, in the beginning of 22, rates were around 1%. But I definitely think that if the market perceives that, we don't have this inflation thing completely under control, that stimulating is not a good thing. And that's going to be the question that we have going forward. And I'll emphasize again, no one really has a good theory about how inflation works. So, and I know everybody likes to confidently say they know what's going to come next on inflation, but it's a very complicated dynamic.
Well, it has been declining. You look at where the current S&P returns are, 15% within the year, first rate cut, and that's if there's no recession. They're kind of analyzing this on this Kobe piece. And you look at that, and I kind of wonder, because the S&P obviously has been hitting all-time highs left and right. Does this have any risk for a reversal on inflation where we actually start seeing the slow or possibly even starting to rise again, even with Fed rate cuts in place? What are your thoughts on that?
Yes, what happens after the first rate cut, to start with that part, it really depends on what the economy does, because people look at the first rate cut, and if there is a beginning of a rate cut and we don't have a recession or we don't have a resurgence of inflation, then stocks they go big. 1995 is probably the big example. That was probably the only soft landing we've ever seen in the last 80 years, although we constantly predict that there's going to be a soft landing. There's only really been one. But then there's other instances like 2008 or 2020 that the first rate cut is a signal that everything's falling apart, and it's probably the maximum sell point for the market. So really, we got to look at, okay, the Fed's going to cut rates tomorrow. What's coming next? Is a slowdown in the economy coming? That could be bad for equities.
Right.
Is no slowdown in the economy coming, and we're just going to get cheaper money without, and this is an important qualifier, without a resurgence of inflation? That could be extraordinarily good for equities.
Yeah.
So there's still a lot of unknowns that are still ahead of us. I know that there's a lot of people on Wall Street that like to think when it comes to interest rates, up is bad and down is good. And that is not always the case. It really is with interest rates. Why are they going up? Sometimes it's good because it means there's strong growth and there's earnings. Sometimes it's bad because it means that they're worried about inflation. So,
Yeah.
And lower interest rates can be the same thing. Sometimes it's good because all of the concerns are alleviated. We can lower rates, and sometimes it's bad, like 2008 or 2020. We just, hit the wall and things are getting ugly and we got to cut rates to try and stop it. And that won't be perceived as being a good environment for stocks.
Well, I think, our show, we cover a lot on the blockchain side, crypto, et cetera. And many of the people who invest in that also look at more of the riskier assets on the S&P 500, whether it's in the tech stocks or some of the mid caps even. So with that being the case, and I want to go to this tweet right here talking about Warren Buffett's strategy, because he's holding a lot of cash right now and continues to kind of go in that direction. Many people would say, all right, he's basically parking cash. He knows something or he's anticipating something, and this could be a long play over the next 5 years, or it could be an immediate play over the next 12 to 18 months. When you look at a major investor like Berkshire Hathaway starting to really go into a cash position, what does that signal?
Well, keep in mind that he's been in a cash position now for several years. So this is not new. And actually, he's the largest private owner of treasury bills in the world. I think he owns 8% of all treasury bills outstanding, if I remember the number correctly. So he has been in a defensive posture on the stock market now, probably since about 22. And I mean, he's made it very clear through his writings, his annual meetings and everything else, that he sees that the market has very little valuation. He's holding his cash, getting 5% a year, hoping for a big decline in markets so he could scoop up companies at a cheaper level. Now that I've said that, will he be right? Well, we all know that Warren Buffett has a great track record. But what we forget about Warren Buffett's track record is Warren's bearish on market. Yes, and sometime in the next 10 years, he's going to be proven right. But people like to think Warren's bearish on the market sometime between now and 2 p.m., he's going to be proven right. So he's playing a much longer game than everybody else is playing right now. And, you might say, or I might say, he's been wrong for 2 years. He might say, nah, I'm still working on the position here. We'll see. Give me another 5 or 8 years and let's see how it goes.
Yeah. Much longer thinking, I think, when you compare his strategies. And his strategies are much more conservative, but yes, he definitely goes into these long-term plays. And he has shown very well in terms of his returns for sure. You look at a couple of other scenarios that are playing into the market. Elizabeth Warren came out with her demand to the Fed saying, hey, give us a 75 on this. Do you think this has any kind of bearing on whether or not the Fed is even considering, back to your point earlier in the interview here, saying that, it's kind of a toss-up between the 50 and the quarter, or is something like this a much more striking cut in play?
No, I don't think that's in play. Liz Warren has been doing this at every meeting now for the last several, where she pens a letter to Jay Powell saying that he needs to cut rates aggressively all the time. So it's nothing new. Right. This is part of the Fed's history between presidents and politicians trying to influence them. They hear it, but I don't think it has any play in their decision-making process. I really think it really comes down to the 50 or the 25, really comes down to what, as I said earlier, the signaling. Do they think that the neutral funds rate is defined as what's the rate when we're not stimulating the economy or restraining it? They think 5.25 to 5.5, that's the range it's in now, is restraining the economy. Okay, well, where do they need to go so that they stop restraining the economy? Is it 4% or is it 3%?
Right.
And that 50 would tell you it's 3%, because otherwise, if they kept going a quarter point, it would take them until middle of 2026 to get under 3%. So they want to get going on this by going by 50 and then go by 50 and go by 50 so they can get to that under 3% in about a year. So that's really, really what they're trying to signal here. And that's really what they're considering. And whether or not Liz Warren wants 75 or 500 or whatever she wants, I don't think it has any play with what they're going to do.
With that in mind, and you look at the next meeting, which will be right after the election. Literally, it's on the heel. I mean, maybe in the same week. I think it's November.
Yeah, it
6th
is. It's 2
7th.
days after the election.
Yeah. So how do they play the strategy? Because will this week have a bearing on how that plays out more predominantly for a real rate cut, maybe to get in line with what you're talking about, which is maybe a catch-up scenario to get under 3 or under 4?
I've often liked to use the quippy line that the Fed is not partisan, but they are political. What I mean by not partisan is they don't sit around the FOMC meeting, and let's be blunt, they don't sit around the meeting and go, we don't like Trump, so what do we do to get him out? They do not do that. But they are political. They are very aware about their reputation, about what people might perceive that they're doing or perceive their politics. And so this meeting, tomorrow's meeting where they're going to cut rates, is kind of unique because the Fed is going to be changing policy tomorrow, policy, going from hold, because they haven't moved in 14 months, to cutting.
Right.
They almost never do that right before an election. If they're raising rates going into the summer of an election year, they can continue to raise them. If they're cutting going into the summer of an election year, they can continue to cut them. But if they're holding going into an election year, summer, they usually continue to hold. So they're going to change their policy right before the election. So this is going to have a lot of political undertones to it about them changing policy ahead of the election. Now that I've said that, this election is unlike any election we've ever seen, with the changing of the candidates and all of the other unique things about this election. The stock market made a new all-time intraday high, the S&P did, this morning. So I don't think the idea is the traditional idea, oh, the Fed's going to cut rates and the stock market's going to go up another 5 or 8% between now and election day. And that's going to get people to switch their vote to the incumbent party because the stock market's going up. Maybe in the past that's been the case, people think about it, but I don't think that matters at this point, whether or not the stock market goes up. Not after we're having assassination attempts and switching candidates and everything else that's kind of dominating the political atmosphere. And that might be one of the reasons why the Fed might be moving before the election. Look, at this point, I've heard Federal Reserve officials tell me when I've asked them, whatever we do on September 18th, they're going to yell at us. If we don't move, we're going to get yelled at. If we move, we're going to get yelled at. So we might as well do what we want to do because we're just going to get yelled at either way.
Yeah. Well, and you're right. I think it's one of those scenarios, kind of a catch-22. All right, so you look at the S&P 500 all-time high. We're also looking at gold, which is now in a position that many people would say, okay, hey, gold is on the move. Is it an escape velocity that we're looking at? Could it really skyrocket maybe to over 3,000? What is your opinion right now on gold and why it's doing so well?
Well, gold has always been an uncertainty asset, right? You buy it when there's a lot of uncertainty. I know that now one of those uncertainties is inflation, and it kind of gets lumped into that category that it's an inflation play. It's not always an inflation play. I mean, it could be a deflation. Whenever people think bad things are going to happen. I think what's been rallying gold over the last several weeks, and over the last 2 weeks in particular, when it's really been taking off, is this perception of what I've been hinting at. Fed's going to go too far. They're going to cut 50. They're going to cut way too much. We're going to wind up in the middle of 25 or late 25 looking back and going, oh, wow, we've got inflation all over again. They did a version of transitory that they did in 21. They were on their way to getting inflation solved, and then they overstimulated. We also did this in the late 70s. The G. William Miller Fed did exactly the same thing. They thought inflation was fixed in 75, 76, started cutting rates, and then we had a higher high in inflation in 1980. Yeah. And that's what I think gold is sniffing out. Now that I've said that, and that's what gold is sniffing out, that doesn't mean that gold's right. It means that that's what gold players are worried about, that they're going to go too far. They're going to create monetary excess, and that's going to create stress in the financial system because it's going to create inflation. Quick word about inflation. Inflation impacts 100% of the population. Elon Musk suffers from inflation. Tesla and SpaceX and X wind up suffering from it. Maybe he doesn't personally. To people on public assistance, suffer from inflation. It is one of the biggest scourges you can have when you have rising prices. No one is immune from those rising prices. And that's why gold looks at the idea of monetary excess, maybe leading to inflation. And it says our role is people come here when they're unworried and there's uncertainty, And inflation is a big one, and that's what they might be sniffing out right now.
Interesting. Now, over the last 18 months, we've had a couple of times where inflation looked to be on a trend downward, then a nice little bip up. I think it was about 6 months ago. Fed kind of reacted by holding. We weren't seeing additional rate cuts. And you've got the scenario playing out with gold right now. Right now, it seems to be on a waterfall effect, at least inflation, especially if you look at things like trueflation, where it's now down around 1%. If we were to see a pivot on inflation, because retail sales came in a little bit stronger, is the economy really in trouble? And could there be a resurgence of inflation? And if so, how does the Fed react?
Yeah, I mean, there could be a resurgence of inflation. I mean, I'll go back to what I said earlier. It is an extraordinarily difficult thing to understand inflation while everybody tells you that they know what inflation is going to do. And most of the time, people fall into this, what I call the autocorrelation trap, right? Mm-hmm. Well, look at what inflation has been. Look at where it's been the last several months, its trend. Autocorrelation means that the next plot point, the next one after that, will be influenced by the last one. And that's not the case with inflation. Inflation can be a sharp downtrend or uptrend. And then starting next month, it can just change course. Look at June of 2022. When it hit 9%, it was going straight up. It was going vertical. And, it's going to go 10, 11, 12% is what everybody said. And that was it. It was done. It turned around and went right back down. And so I think what you could see with inflation is something along those lines, is that it could change course. It could change course and go straight down to 1%, or it could change course and go back up. Now that I've said that, I happen to be in the camp that I don't think we've gotten completely beyond this inflation problem. I've been arguing that 2020 was one of the biggest the shutdown restart of the economy was the biggest economic events of our lifetime. It is going to have a long tail implication on the economy. It ended the 40-year bull market in bonds, and it's now changed the dynamic of inflation. That those that are looking for that pre or below 2% inflation to return, I've often used the phrase, we're not going back to 2019. This is a post-COVID economy. And those that keep thinking we're going to go pre-COVID, witness Amazon yesterday saying that all of their workers have to come back to the office 5 days a week.
Right.
That's pre-COVID thinking. Your workers have been out of the office for 4.5 years. Mm-hmm. Some of them moved away 3 years ago. Now you're saying to them, I want you back in January? Good luck with that. And, anywhere from General Motors to the federal government to Axis tried to get everybody back. Goldman Sachs coined the phrase 5-0. And they've all had to cave on this because they've all had to understand we're in a post-COVID economy when it comes to remote work. We're in a post-COVID economy when it comes to inflation. And I think that that's what we really have to get our head around, because most economists think, we shut down the economy. Everybody went home, got a PPP loan. They all went back to work, and it's all went back to the way it was. No, it didn't. It changed. Change does not mean dystopian. It does not mean worse. And I think we're in an era of higher inflation, which means we're in an era of higher interest rates. If I'm right, and we are in an era of higher inflation, it comes back to that, is the Fed going to 4 or 3? Because if we're in an era of higher inflation and the Fed wants to go under 3, there's going to be a point when the market's going to say too much. You're going to create more inflation. We've already got too much as it is, and you're going to create even more. And you could see a 2022 type of reaction in markets where both stocks and bonds sold off badly. If I'm wrong, and inflation is going to go back under 2%, and everything is going to go back to the way it was pre-COVID, when it comes to inflation, then the market will celebrate that type of move. So we'll have to see whether or not this inflation thing does continue on its way down. I think it's a very open question at this point, because even those that said that inflation was transitory never thought that we'd get to late 24 and still have core inflation above 3%. Core inflation was supposed to be back under 3% by the end of 22, early 23. It's already 2 years late on that, and it still hasn't gotten to that level right yet.
Well, I mean, when you have the kind of stimulus that went into that economy at that period of time, no one really understood the impact it would have, especially kind of the trickle-down impact of new businesses starting, longer term lines in terms of how businesses are growing and where they're getting their capital from. So I'm kind of in agreement with you a little bit. We're still a little bit skeptical as to whether or not this is going to be a soft landing or not. So we're going to be watching it closely tomorrow, Jim. Definitely thank you so much. If you guys want to check out Bianco Research, just jump over to his website right there. But thanks for coming in today. We appreciate it.
Thank you.
You bet. Excellent. Now, if you guys are not in our private member group, which is our Diamond Circle, you can get in there. We do additional market analysis over there. A lot of additional content that doesn't come over here to the YouTube channel or over to the podcast stream. So make sure and just click the link down below and you can get in on that. Follow me out there on X, which is just at Paul Barron. We'll catch you next time right here on TechPath.